Let's begin with introduction of leasing. Leasing is an important tax avoidance scheme for asset acquisition. The lessee will not be able to improve its cash flow position, but also able to achieve tax efficiency. In tax planning, the deduction of revenue expenses is superior than claim of capital allowance. To ensure all lessors within the leasing industry has consistent tax treatment on leasing transaction, and to combat tax avoidance, Income Tax Leasing Regulation 1986 was gazetted. For legislation, we can refer to Section 36 Subsection 1 Income Tax Leasing Regulation 1986. Director General has the power to legislate only on movable properties and not immovable properties. First of all, let's understand the meaning of lease. According to Section 2 Income Tax Act, a sublease, a tenancy for 3 years or less, and any agreement for a lease or sublease. While in Regulation 4 ITLR 1986 stated that any kind of agreement or arrangement under which payments are made for the use of an asset.
As according to Regulation 2 of ITLR 1986, there are two types of business sources of leasing companies, which is non-leasing and leasing. Business 1, which is non-leasing, refer to the hire purchase transaction. It cannot claim capital allowance on the hire purchase asset as the company is not the owner of such asset. It can only claim capital allowance on plant and machinery owned and used in the business. Business 2, leasing company, can only claim capital allowance on plant and machinery owned and used in business. It capital allowance on leased asset. Gross income of lessor, Regulation 3 of ITLR 1986. Section 24, subsection 1C, in a relevant period, a debt owing arises in respect of use of employment of any property dealt at any time in carrying the business, a debt shall be treated as gross income. Regulation 3, total sums of lease rental received is accrued evenly throughout the lease period. The lessee position is not affected if Director General even out the lease rental receivable for lessor. In hire purchase business, the lessor would recognize interest income as gross income.
Now, let's proceed with situation where lease agreement or arrangement shall be deemed to be a sale agreement. This is based on Regulation 4 ITLR 1986. In the event of a deemed sale situation, lessor can only recognize interest income and will not be able to claim capital allowance on leased assets. Lessee is given an option to purchase the asset during or upon expiry of the lease term. The option may be stated in the lease agreement or subsidiary agreement or memorandum of understanding, while under Hire Purchase Act, an option to purchase is a hire purchase contract. Lease is given the beneficial ownership of the asset. In leasing agreement, the lessee is not legal owner even though he is responsible for the safekeeping of leased asset. The lessee merely has the possession and custody of it. In the situation where the lessee beneficial ownership, the lessee is said to have such ownership.
Sale and leaseback. If the lessee has claimed capital allowance in respect of the asset prior to the lease, it would be treated as a sale arrangement. This refers to the sale and leaseback arrangement. Right to sell or dispose the asset. When the lessee is given the right to sell or dispose of the asset and receive the proceeds or a portion of the proceeds from the sale, it would be deemed sale agreement. Acquisition of asset below market value. If the lessee acquires the assets directly or indirectly during lease term or upon expiry of the lease at a price of other than market value prevailing at the time of acquisition, the lease would be treated as a hire purchase contract. Special purpose asset. If lease asset comprises of a special purpose asset, then the lease would constitute a sale. Happen in the situations 1. Custom-made asset, and 2. Asset is an integral part of building, for example escalators.
Now, Let's discuss about the tax implication of ITLR 1986, the lesser non-deemed sale situation. This situation whereby none of the circumstances stipulated in Regulation 4 applies. Income recognized by lease rental received or receivable from the lease asset for the leasing business. The capital allowance on lease asset is claimed by the lessor, as he is the owner of the lease asset and such asset is in use in leasing business. Secondly, the deemed sale situation. Situation where any one of the circumstances stipulated in Regulation 4 applies, while the income recognized by interest income received or receivable on an accrual basis. The capital allowance is on lease asset is not given to lessor, but instead claimed by lessee. Lessor not allowed to claim the capital allowance on deemed sale asset.
Lessee, non-deemed sale situation. The full rental incurred by a lessee is a revenue expense deductible in adjusted income. Lease rental for use of plant and machinery is revenue expenses. In a situation where the lease rental incurred is in respect of a motor vehicle, passenger vehicle, the lease rental is restricted to 15,000 per vehicle. The restriction does not apply to commercial vehicle such as lorry, bus, minibus, van, station wagon, or taxi cab. This is according to Section 39, Subsection 1K. Deemed sale situation. Current practice. In a deemed sale situation, lessee will be deprived of revenue deductions. The lessee is deemed the owner of such assets. The lease treated as hire purchase agreement. The interest element would be allowed as a revenue expense. Lease rental as revenue expense. Whether the existing practice is correct in law is questionable. The regulation merely stipulates deemed sale situation for the lessor. The lessee is always entitled to claim lease rental as an expense in all situations for both deemed sale and non-deemed sale.
For accounting treatment, we differ it between finance lease and operating lease. The duration for finance is long-term, while operating is short-term. The cancellation for finance is we cannot cancel it, while operating we can cancel it. Maintenance of service insurance and cost of repairs is from lessee for finance, while lessor is for operating. Paragraph 20 of FRS 117 requires the lessee to capitalize the finance lease asset in the balance sheet and depreciate it accordingly, while operating lease is expense of the profit and loss accountant during the year.
Interaction of the ITLR 1986 and the accounting standard. The chart shows the leasing transaction. Does the ITLR 1986 apply? If yes, it is a deemed sale. Then the lessee can claim to the capital allowance of hire purchase. Does FRS 117 apply? If yes, then it can claim under capital allowance. No change in treatment. If no, claim capital allowance under hire purchase and add back capital portion of installment paid. If the ITLR 1986 does not apply, lease rental allowed as revenue expense. And does FRS 117 apply? If no, there is no adjustment. And if yes, claim revenue deduction capital portion on installment paid. Revenue expense capitalized.
Allocation of expenses between leasing business and non-leasing business. Now, we have to know the background of the issue. It's taken up by ELAM as early as July 1990, brought up by MACPA or MIA. The ratio of lease rental receivable to gross income from other sources. The ratio of lease debtors or assets to loan and advance. Let's move to an equitable consideration. Leasing. is a fund-based operation. It is the same amount of funds will be required to acquire an asset for lease. Referring to IRB practices, all expenses of a leasing company should be allocated based on leasing turnover or gross profit. Gross income of leasing for tax purpose is rental receivable, while gross income of non-leasing is interest, fees, or commission.
Impact analysis. Lease rental consists of the elements of principal repayment plus interest. Hire purchase reports only interest income, comparing gross installment for leasing to interest element for non-leasing gives rise to an excessive expenses being allocated to the leasing business. MICPA or MIA view. Interest expenses to be allocated based on the ratio of lease debtors, assets to loan or advances. All overhead expenses to be allocated based on the lease rental receivable basis. A leasing company have more than one source of income should be allowed to elect basis other than the basis confirmed by the IRB.
The final saga. Dispute on the basis of allocation has great impact on income tax payable. The taxpayers who is not satisfied with the tax authorities' treatment may appeal to the SP.Com.
The example of case is in Ketua Pengarah HDN against Daya Leasing Sendian Berhad, 2005. Court of Appeal give the final decision to the tax authorities. Gross income for leasing business comprised of principal, interest and incidental income. Gross income for non-leasing business comprised of interest and incidental income. Postscript. Leasing industry must submit a memorandum to the Ministry of Finance. It allows the interest expense to be apportioned between leasing business and non-leasing business.
Cross-border leasing. Lessor and lessee share the same objective, that is to ensure that the deemed sale arrangement stipulated in Regulation 4 does not apply because the lessor wants to claim capital allowance to shelter its lease rental received from business. Secondly, the lessee prefers to claim lease rental deduction rather than capital allowance. Now, I will describe about foreign lessor. It prefers a deemed sale situation. Based on Section 15, the withholding tax would be levied on interest element, while in Section 4A, withholding tax in the non-deemed sale situation. Withholding tax. It arises when lease rental paid to an offshore lessor. It paid to non-Malaysian resident lessor, which is 10%. This is based on withholding tax Section 109 or Section 109B. Section 109B is applicable when lease rentals are for movable asset. As a conclusion, leasing company is regulated in Section 36, Subsection 1 of Income Tax Leasing Regulation 1986. In leasing companies, there are two businesses which are non-leasing and leasing. Each business will give different income. There are also several situations which lease agreement shall be deemed to be a sale agreement. That's all from us.
Thank you.